Welcome back to Iron Financial. This is the only place on the internet where we help you actually forge a stronger, more resilient portfolio and cut straight through the market's everyday weakness. I'm your lead analyst, and today's explainer, well, it's going to require some serious heavy lifting. Today, we are putting Box Incorporated right under the microscope. Look, right now, we are witnessing an absolute bloodbath in the enterprise software sector. High interest rates and brutally tightening IT budgets are exposing massive structural cracks in some of the most beloved legacy platforms out there. Just look at the carnage lately. So today, we are dissecting Box's Q1 fiscal 2027 earnings. We need to see if this company is pouring a solid, load-bearing foundation for your capital, or if they are just building a really shiny, completely hollow artificial intelligence facade that's ready to crumble at the very first sign of macroeconomic stress. We're going to drill deep. We're looking into the revenue, the operational leverage, the margins, and the underlying structural integrity of their entire business model.
And I'm the Market Skeptic. I'm here representing you, the retail investor, who is just frankly tired of being sold a bill of goods. Because let's be honest with ourselves for a second, every single software company right now is slapping the letters AI onto their investor decks. They're hoping to catch a multiple expansion, and they're promising the moon to anyone who will listen. My job on this desk is to ask the tough questions. As we just said, we've seen industry titans, companies like Salesforce and Workday, show serious cracks in their growth narratives recently. So is this recent financial buzz around Box a legitimate structural breakout? Or are we just looking at a hype-driven tech trap waiting to cave in on investors who are foolish enough to buy at the top?
That is exactly what we are going to drill down into today. Before we do, make sure you hit that subscribe button to Iron Financial, and let's get right to work on these blueprints. This right here is the central, load-bearing question for anyone holding or even considering opening a position in Box right now. We've seen software-as-a-service companies get completely hammered in the market recently. Multiples are compressing rapidly, and Wall Street's patience is running razor-thin. Now, Box's CEO, Aaron Levie, is aggressively pushing this narrative about what he calls the Agentic era. He's suggesting that AI is completely rewiring how enterprise content is handled from the ground up. But as an investor, I don't care about the buzzwords. I need to know if this is real, monetizable, structural growth. Is this AI pivot actually reinforcing their business and driving net new dollars in the door? Or is this just a really expensive vanity project?
To answer that, we have to completely ignore the PR spin and the flashy keynotes. We go straight to the raw materials. We evaluate the hard numbers. And the numbers from this first quarter paint a highly specific picture of a company undergoing massive structural renovations. Let's start by looking at the sheer load-bearing capacity they just reported on the top line.
$306 million. That is the Q1 revenue figure, and let me tell you, that is a massive concrete pillar planted right in the center of Box's foundation. This isn't just a slight beat on some analyst spreadsheet. It's the top-line cash flow that sets the stage for the company's entire structural integrity going forward. Think about it. When you are evaluating a company's ability to survive and thrive in a really tough macro environment, especially an environment where enterprise IT budgets are being scrutinized by CFOs with a fine-tooth comb, you always start with predictable cash flow. Box is a subscription business. That means that $306 million represents highly recurring, incredibly sticky revenue. They are proving right now that they have the scale and the sheer weight to absorb unexpected market shocks. But look, a static number doesn't tell us anything about momentum. A foundation has to be able to expand if you want to support a taller building. We need to know if this concrete pillar is actually growing. Context is absolutely everything in structural analysis, and the context here is an 11% year-over-year revenue growth. Why does this specific, seemingly modest metric matter so much to Wall Street? Because for over 12 consecutive quarters, that is 3 solid years, folks, Box has been trapped in a brutal consolidation period, hovering stubbornly in the single digits. Wall Street viewed them as a mature, slow-growth storage locker, nothing more. So this 11%? It represents a massive structural breakout. It is the first double-digit growth they've posted in a very, very long time. During the earnings call, analysts like Josh Baer from Morgan Stanley actually paused the fundamental business questions just to congratulate management on hitting this exact double-digit milestone. It proves that Box's strategy of aggressively moving their legacy users up to higher-priced bundled tiers isn't just a theory on a whiteboard. It is actively driving top-line expansion in a market where practically all their competitors are bleeding out. Okay, fine. 11% is a breakout. I will give you that. You've poured a nice, solid pillar. But let's not ignore the rust that's already forming on the rebar here. Market Skeptic. Aaron Levie claims Box is building the leading intelligent content management platform for this new Agentic AI era. And hey, that sounds fantastic in a press release. But that grand vision is slamming headfirst into a very harsh macroeconomic reality right now. Lucky Schreiner, an analyst from D.A. Davidson, brought up a crucial, deeply concerning point on the earnings call. Enterprises are facing severe AI budget fatigue. Let's be real, large language models cost a ton of money to run. Every single prompt, every single query an employee types in costs a fraction of a cent. And when you multiply that across 10,000 employees doing it a dozen times a day, that turns into millions of dollars in completely unexpected cloud bills. To combat this, IT departments are starting to implement what Schreiner called token optimization and incredibly strict cost controls. If customers are meticulously rationing every single AI token they consume just to save a buck, how does Box's AI foundation actually hold up? Aren't they just going to get squeezed completely out of the IT budget the minute the CFO tells everyone to stop querying the AI? See, that fear right there represents a fundamental misunderstanding of Box's actual product architecture. Intelligent content management, or ICM, is not about generating the tokens themselves. It's about securing the underlying data that those tokens absolutely need to be useful. Box is not just selling a flashy AI interface that racks up compute bills. They are positioning themselves as the secure structural steel managing the unstructured data that other AI agents rely on. Levy stated it clearly on the call. Enterprise content sits at the absolute center of every single enterprise's agentic strategy. Think about it. If an enterprise builds a custom AI or they buy an off-the-shelf application, that AI needs secure access to the company's internal data to prevent it from just hallucinating nonsense. It needs what is called retrieval augmented generation, or RAG. Box's core value isn't compute. It's in data security, strict governance, and compliance. They are the headless platform layer. They aren't the expensive LLMs generating the massive compute costs. They are the impenetrable vault that those models require to function accurately in the first place. All right, let me drill into a critical vulnerability right there then, the user interface layer. Josh Baer from Morgan Stanley specifically pushed on this on the call. Is it actually important to win the UI? Because if an enterprise is doing all of its daily interactions through an external third-party interface, say an employee is living entirely inside Microsoft Copilot or Google Gemini all day, doesn't Box just become a highly commoditized, completely invisible storage locker in the basement? We've seen this exact structural failure happen in the travel industry, right? Aggregators like Expedia stole all the margin and all the profits from the actual airlines simply because they own the customer interface. The customer doesn't care whose plane they're on, just who sold them the ticket. If Box doesn't own the screen the employee is actually looking at, did they lose their pricing power and their structural durability entirely? And that is exactly the trap most retail investors fall into, thinking that the flashiest, most visible part of the building is automatically the most valuable part of the real estate. It's just not true here. Yes, the UI layer is highly visible, but it's also incredibly competitive, highly prone to user churn, and brutally expensive to run and maintain. Meanwhile, secure infrastructure governance, that is where the real unbreachable moat is built. Levy argued brilliantly on the call that as your exact fear, token budgeting, becomes a bigger and bigger issue, the real financial value will accrue to the infrastructure layer, not the UI. Why? Because a secure, neutral infrastructure layer allows the customer to swap out different AI models for different workloads based entirely on cost and efficiency. Box's neutral architecture allows an enterprise to use a really expensive Copilot model for complex software coding, but then use a dirt-cheap open source model for just summarizing basic PDF documents. And they can do all of that while maintaining strict, centralized security governance over the underlying files. Box is the neutral ground. In a massive AI price war between the tech giants, being the neutral infrastructure is a massive, highly profitable structural advantage. Now, let's shift focus to the primary rebar that is actually reinforcing their current growth, Enterprise Advance. Box isn't just selling basic legacy cloud storage anymore. They're aggressively pushing their existing customers up market into this incredibly comprehensive suite. When analysts like Steve Enders from Citi asked management about what is actively driving the fundamental pipeline right now, they pointed directly to Enterprise Advance. Let's be clear. This isn't just a slight add-on feature or a nice-to-have widget. This is a core load-bearing product here. It packages their Box Shield security protocol, their highly complex data governance tools, and all their new AI capabilities into a single, high-margin offering. They aren't just trying to win new logos. They are forcing a massive, highly profitable structural upgrade cycle across their entire existing customer base. And for those of you who might be newer to the trading desk, here is a quick masterclass in sauce metrics. 105% is Box's blended net retention rate, or NRR. NRR is the ultimate undeniable measure of a software product's structural stickiness. Anything over 100% means that even if you lose some customers to churn or downsizing, your existing customers are spending so much more money with you that your total revenue still grows. Now, on the surface, 105% might seem pretty standard, maybe even a little boring, but you have to dig into the earnings call transcript to understand the real mechanics at play here. Management explicitly stated that the expansion rate for Enterprise Advanced customers is actually significantly higher than the company's overall average. What does that mean? It means Enterprise Advanced is structurally lifting the entire company's revenue momentum on its back. They aren't just achieving this by adding more user seats in a tough hiring market. They are upgrading legacy customers to this new expensive tier. Every single time they make that migration, the foundation gets thicker, the operating margins improve, and the revenue becomes incredibly permanently sticky. To keep that NRR expanding and driving upward, Box is actively pouring dense new product innovations. Let's look at the actual mechanics of the blueprint they are rolling out: Box Agent and Box Automate. We're going to drill down into the technical weight here because it is absolutely crucial to the thesis. Box Agent allows a user to interact directly with their specific, highly secure enterprise data. Imagine a corporate legal team dropping a 500-page, highly confidential vendor contract into a secure Box folder. Box Agent can instantly summarize the massive liabilities, extract highly specific termination clauses, and even compare it to previous contracts, all without that sensitive data ever leaking out to a public LLM. It's totally locked down. Then, Box Automate takes over. Based on the liabilities extracted by the agent, Box Automate can trigger a dynamic workflow, automatically routing that specific contract directly to the chief financial officer for a digital signature, while simultaneously sending a redlined version back to the procurement team. When you integrate custom automated workflows like that deep into a massive corporation's daily operations, you aren't just a software vendor anymore. You become structural to their daily survival. You are literally replacing hundreds of manual labor hours. That deepens the platform's value so much, making it incredibly painful and financially disastrous for a company to try to rip Box out and switch to a cheaper competitor. Let's ground this whole technical argument in some hard, undeniable corporate data. This is exactly where the steel meets the concrete. Box just raised their full-year fiscal 2027 guidance to roughly $1.28 billion. That represents a very solid 9% year-over-year growth on a truly massive revenue base. But listen to me, the true strength of this quarter isn't just the top line, it's the operational leverage. They delivered a massive, expectation-beating 28% operating margin. In the SaaS world, we always look at the rule of 40, which is your growth rate plus your profit margin. At 11% recent growth and 28% margins, Box is pushing a 39, putting them right on the edge of elite world-class territory. They are proving right now that they can grow the business and generate significant, tangible free cash flow at the exact same time. They are funding really heavy investments in AI capabilities and industry-specific solutions, but they are doing it with intense, ruthless financial discipline. They aren't out there just buying growth at any cost. They are engineering it profitably. Okay, I need to stop you right there, Lead Analyst, because this is exactly where the cracks might be showing in this whole narrative, and we need to scrutinize this aggressively. Taylor McGinnis from UBS caught this exact discrepancy on the earnings call. So Box had an incredible Q1 billings outperformance, right? And management's forward guidance assumes low double-digit constant currency growth in the first half of the year. Beautiful. But if you actually sit down and run the math on that $1.28 billion full-year target they just bragged about, it creates a massive discrepancy. The implied guidance for the second half of the year drops drastically into the high single digits, sitting roughly around 8%. Why? I mean, if the enterprise advanced demand is supposedly so incredibly strong and structural, why the sudden deceleration? Is there a structural macroeconomic slowdown coming down the pipe that they aren't warning us about? Are renewals just pulling forward into the first half, leaving a massive gaping hole in the back half of the year that investors are going to fall right into? The CFO, Dylan Smith, directly addressed that exact mathematical concern on the call. And honestly, it comes down to prudent margins of safety. This isn't a sign of structural failure or a gaping hole. It is classic, conservative financial modeling from a veteran CFO. Smith explicitly explained on the call that the delta you are seeing is purely a function of comparing actual, locked-in, contracted performance in the near term against unbooked expectations for the back half of the year. He stated very clearly they want to ensure they are setting expectations that they have a very high degree of confidence in meeting or exceeding. Look, in a volatile macro environment like we are in today, where enterprise IT budgets can literally freeze overnight, you absolutely do not overpromise on your structural load capacity. You build a very wide margin of safety into your forward guidance. Management is making sure they don't get brutally punished by Wall Street if enterprise budgets happen to tighten by 50 basis points in Q4. It's just smart defensive engineering. So let's lay it all out right here on the trading floor. The steel versus the rust. On the steel side of the ledger, we have an undeniable 11% year-over-year top-line breakout, violently snapping a 3-year streak of absolute stagnation.
Yeah, but on the rust side, we have that implied second-half guidance dropping right back down to 8%. That is a mathematical deceleration. I don't care how conservative the CFO claims to be.
Fair point, but we balance that against an elite 28% operating margin performance that proves they are running a ruthless, highly profitable ship right now, alongside a 105% net retention rate driven by massive enterprise upgrades to their advanced tiers.
And I counter that with the very real, very heavy macroeconomic risks of token budgeting. If IT departments are sweating their cloud bills right now, and they decide to slash their overall AI spend just to optimize costs, Box's grand Agentic era vision might hit a solid brick wall, entirely neutralizing that entire enterprise advanced pipeline you love so much.
It is a seriously heavy debate. The operating margins are incredibly robust, no doubt, but the macroeconomic headwinds are completely relentless right now. We've broken down the raw financials, we've stress-tested the structural integrity of their new product suite, and we've weighed the flashy AI narrative against the hard mathematical data. Based on the 28% margins and the breakout top-line growth we just saw, I argue the steal here is very real, provided you have the stomach as an investor to weather the potential second-half guidance slowdown.
So, to everyone watching, what is your move? Are you buying the steal here, or are you too afraid of the rust? You have to weigh the heavy lifting Box is doing with their workflow automation against the broader market's very real AI token fatigue.
Do your own due diligence, make your decision, and forge your portfolio. We hope this explainer gave you the exact blueprints you need to make the right call. For more uncompromising, heavy-lifting market explainers just like this one, make absolutely sure you hit that subscribe button to Iron Financial. We'll see you on the next earnings breakdown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.